Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast. Today we're going to be interviewing Russell Jacobs, and we're going to continue to explore what the CFP, the Certified Financial Planner, truly means. There are lots of different categories of what you are expected to know as a CFP, but I want to work with Russell today to talk about something a lot of CFPs don't talk about, which is risk management and insurance planning. Not the sexiest conversation we're going to have, but very, very informative. And if you are working with a CFP and they're not talking about this, then they are actually derelict in their duties of what the ethical standards that they've stood for. So, Russell, welcome to the show.
Thank you, Matt. Glad to be here.
All right, brother, let's jump right in and talk about the principles of risk and insurance. How do you define that, and how does that go into your planning?
Well, risk management and insurance is really just what it sounds like. You analyze your situation, the perils that you're exposed to, and that can be to life, family, property, anything can be insured just about. And then if you decide you want to either insure that risk or by a third party of some sort, depending on the type of risk it is, or avoid that risk, or mitigate that risk, which in some cases you can do through structural or behavioral changes. But the risk is there. It becomes a question of how you choose to management, thus the term risk management. And you literally can do it by one of those three things: mitigate, avoid, or insure, or some combination of the three is typically more what happens.
When you look at and you evaluate those risk exposures, what do you do? You've been doing this for a long time, Russell, and I'm not saying you're old. I'm saying that you're quite experienced.
I'm getting there.
You're getting there. When you look at making an analysis, would you mind telling the audience a little bit about what that analysis looks like and what they need to provide to you to help you make that analysis?
Sure. Yes. Well, we're more in our risk management space. That typically means life insurance, disability insurance, long-term care insurance, and we partner with others or collaborate with them because we don't any longer provide health insurance and we never at this point have done property and casualty insurance. We would work with others, but and in our situation, it always is about your goals and objectives, your time horizon, risk tolerance, and actual fact pattern, and your propensity to take risk or not. Because really, you can self-insure or you can transfer to a third party. And in most cases, we're talking about if something happens to what we call the perils of life and you're no longer here, you've passed away by accident or sickness, or you've been hurt or sick and you don't pass away, but you're disabled. Or on the other end of the spectrum, if you live too long, you're seeing it more and more where the bodies are maintained, but the mind is not there, or you have debilitating arthritis where perhaps you're in assisted living or have professional home care in a nursing home. And you could describe that as living too long. But in any event, whether it's die too soon, get hurt or sick, or live too long, what does it require? Well, based on your living expenses, it requires capital. And if your ability to earn capital is interrupted due to one of these things happening, then it's got to be replaced. And that's where, through our analysis, we will determine what is an appropriate amount of capital. And then through those other measures of risk tolerance, time horizon, ability to fund, we determine what type of product may be appropriate for you. And then, of course, our objective is to share that with you and educate you to a point that you can make a decision. Because as I've said before in previous podcasts, yes and no are both the right answer. Deliver proper facts to the person that you're working with, become educated in a balanced manner, and then make a decision. Just don't procrastinate, because I've listened to Carl's podcast too, and we both say the same thing. Procrastination is the big killer here. People don't act, and you shouldn't act half-cocked or without full information, but you should act.
Mm-hmm. Now, you just said that you don't do health insurance, but health cost management and the cost associated around healthcare with advanced age is definitely something that you have to address. And I think if you didn't, Carl had said on a previous podcast that that living too long, well, I mean, you just kind of hinted toward it, but living too long can be one of the biggest drains on a person's wealth. So talk about that a little bit.
Yeah, it's a huge capital drain, because it really depends on your circumstances, but you could see a 20% cash flow requirement for cost of healthcare. And who knows what's going to happen with healthcare, but we can always assume it's going to cost us money. Even you're paying for Medicare, and that's means based. So the better you do, the more it costs you. So between paying for your Medicare and some sort of Medicare supplement, there's varieties of that, letter-based, some cover more prescriptions and this and that, but it's a significant expense in retirement, because most people aren't provided subsidized health insurance in retirement. And we're just talking about health insurance there. We're not talking about long-term care where you end up in some sort of assisted living or skilled nursing facility where, I just met with a client last week whose mother is just transferred from assisted living to skilled nursing, and it's $300 and something a day, so $9,000 a month for private. And, they do have long-term care, so that cost is offset. And I think that's another thing to consider. The cost is there if you're going to live too long, and people sometimes get stalled out because they don't feel like they can do a full insurance amount, say in that case $300 a day for the long-term care. But if you do $100 or $200 a day in benefit, you're still partially insuring that. And I always tell people, look, you don't have to fully cover a risk, but something is better than nothing. And that comes back to risk retention, where, if you can't fully insure a risk, whether it be life insurance, disability insurance, or long-term care insurance, if one of these eventualities happens to you, you're still going to be glad you have something. So don't just get frozen into indecision because you don't think you can swallow the whole pill, so to speak, the pill in this case being a premium. And it's just about understanding the dynamics of your situation and that something's better than nothing. And I would say explore options. We always try and look at multiple options and then settle on the best one or two and then share those with the client.
Well, you just opened the door on the next section here, which is your client's ability to earn money is actually the greatest asset they have. And you did touch a little bit on long-term care insurance, but let's talk about disability income insurance. That's something that, from a risk management and insurance planning, is a key component in making sure your plan is in line with really what your long-term financial plans are. Because if you don't have the ability to earn income, what are you going to do?
Yes, and we get a lot of pushback on disability insurance too. And if you're a physician or a lawyer or even architects, often people who have specialty type careers or they were in school a long time, they have a much better appreciation for what happens if I lose the ability to use my hands or can't do certain things, like a lawyer who couldn't speak or something of that effect. But a lot of people who are in more general or regular, if you will, career paths kind of have this thought that they can do, they'd have to be completely, vegetabilized, if that's a word, to receive a benefit, but it's just not true. A significant percentage of home foreclosures are caused by disability. And so there's a story I recall from my early years in this business called The Money Machine, and I think I've referenced it in one other podcast. But the story basically was, in summary, if you had a machine in your garage that produced capital, and you would use a sum of capital that equated to what the individual is making, say it's $50,000 a year, $100,000 a year, whatever the number is not really relevant. And then you ask that person, well, how much would you insure that machine in your garage for? And then the answer is always as much as I could get, but the irony is that machine is you, that machine is us. And we don't look at ourselves in that same light when in fact we are money machines. And so, but again, you don't have to insure that entire risk. And often people have group disability insurance at work. That's usually taxable. So, and it's capped and it's not portable. So we suggest supplemental portable disability insurance on that. But, referencing the home foreclosure comment I made earlier, one of the things we're talking to younger clients about was at least get enough disability insurance where if you got disabled, you could cover your home mortgage payment, your car payment, your core sustenance required expenses, where you don't end up losing your home and your vehicles and so forth, turning a bad situation into a tragedy. And there are even companies now, if you're in the right careers, where you can actually insure your debt obligations. If you're a dentist or a professional of that type, and that's a lot less costly than buying regular income replacement disability insurance, because it's literally specific to the note. So there are a lot of nuances and wrinkles. There's student loan disability insurance where you can just cover that note, and it's much less expensive. Student loan issues are almost at a crisis level, but it's all manageable if you keep your wits about you and work with someone who's helping you sort through things in an educated manner based on your fact pattern, your finances, and your long-term goals and objectives.
Let's talk about annuities. It's a dirty word, unfortunately, in the press, but they have a place in some people's portfolios. Help us with that.
Well, there's various kinds of annuities. There's income annuities, and there are variable annuities. Income annuities tend to be called SPIAs, single premium immediate annuities, or deferred income annuities. And the place they would serve is to kind of de-risk your income receipt in retirement, because in the past, when you worked at Ford Motor Company or XYZ company, you would work there 20, 30 years, you'd retire, you'd get a pension. Social Security today is kind of like that pension, but it's inadequate for most people to sustain their accustomed manner of living. So what the annuity does, in this case, the income annuity, is it replaces that pension by you taking a portion of your asset, allocating it to income, and then no matter what happens in the world, in your life, in the market, that income is going to continue. And it also insures against longevity risk, because as long as you live, it will continue to pay you. And you can add assurances that it'll pay someone or refund your contribution or this kind of thing. Any additional guarantee you add to it reduces the payment to you, but it in fact insures against income streams, so that if you lost your portfolio due to overspending or bad market or some combination of all of that, living too long, this in effect is reverse insurance against that, because it's going to pay you as long as you live in conjunction with your Social Security benefit. So that's the income insurance, the longevity insurance, if you will. The variable annuity, which is the one that often gets the bad press because it's oversold, misexplained, or fill in the blank. Talking heads on television talk bad about it. It's where you can actually put a portion of your asset and keep it invested in the market while having a guaranteed income percentage, often 5%, but it varies with the carrier and with the features. And in effect, if you put $500,000 in there and turned it on immediately, your worst case scenario is you're going to get $25,000 a year, no matter what happens, even if your account value went down to zero. Sometimes people will put money into this so they can leave it invested and be assured that based on that 5% roll up, it will continue to pay them. So that's knowing you should keep money in the market, but you're fearful of risk, you can continue to do so. And if these are after-tax assets, whether it's the income annuity or the variable annuity, then you actually receive payment back with the tax exclusion because you used after-tax dollars to buy it. So you actually will receive a portion of this payment for an extended period of time that's not taxed because you already paid tax on the contribution. You can do this with IRA or what we call qualified money as well, but then it's all taxable when you take it out. And that's one of the bad raps that annuities get is when people take IRA money and put it in an annuity. An IRA on its face is already tax qualified. And so there's a lot of advisors that don't think you should put a qualified IRA into an annuity. And they're not wrong, but if someone is so concerned about market risk that they won't otherwise invest in the market, and this gives them the mental fortitude to do so, then it can make sense. But it's all about balance and proportionality. We limit the percentage of a person's asset that we will ever put in an annuity because they do have restrictions to access, or in some cases you give up principal access completely because of the lifetime income stream. And so problems exist when you speak to an advisor who, because of the commission or their lack of knowledge or whatever reason, they want you to put more than half to 100% of your money in an annuity or annuities, and or if they then want to move you from one annuity to another within a short period of time, because you'll typically pay surrender charges or some other fees of exit and possibly entry. And there's a number of different kinds of annuity, equity index annuities, variable annuities, et cetera. And it really is a murky marketplace. So who you work with is very important. And again, I'd say ask any question that's on your mind and really focus on the purpose of it in your portfolio. And if you're unsure, don't do it. But they can serve a positive place if they're used in proper proportion for the right purpose.
Sure.
And you understand.
So make sure that you're asking a lot of good questions about that. I'm going to say a sentence that I've heard from the media, that any amount of life insurance is better than no life insurance. Let's talk about individual life insurance.
Okay. In what context?
Like, there's lots of different kinds, and we don't necessarily need to go through all of them, even though it'd probably be very helpful. But when you're doing all of your analysis and you're breaking down what clients truly need, how do you make that decision with life insurance? Is there a general rule of thumb that our listeners should pay attention to when it comes to individual life insurance?
Well, I think that there's a term called human life value, and you can look it up on the internet and run a calculator. As I was speaking earlier about the money machine and the garage, people tend to discount their own value proposition. You just want to have an adequate amount of capital to come in if you're not there, so that your family can maintain the lifestyle that you would want them to have and continue to have if you were still there. What type it is a function of your economic position, your sophistication, your understanding of the mechanisms available. And then again, to me, it's about balance and proper proportion. One of the reasons the industry has a bad name is because salespeople oversell, whether it's to get the commission or because that's the only bullet in their gun or whatever. I'm not here to make that decision, but it definitely has a place, and nothing is absolute. So when people on television say there's never a place for, say, whole life insurance, that's just not correct. And factually, we can back that up and educate people to that fact. But term insurance, universal life insurance, whole life insurance, equity index, universal life insurance are the primary types of coverage out there. And there's annual renewable term insurance. There's level term insurance from anywhere from 10 to 30 years where the premium doesn't change. And so it really is, again, an educational effort. And you can also use these things in combination with each other depending on what you're trying to do, because it should always come back to what is your goal, what is your time horizon, what is your risk tolerance, and what is your ability to fund. Because where people truly get off track when they deal with permanent insurance, meaning insurance that has cash value and requires an ongoing premium payment, is that they can't maintain the payment. And if you stop paying any permanent insurance in the early years, especially in the first 3 to 5 years, it's going to be a bad deal for the person who placed that policy. So focusing on sustainability is really the key. And it all comes back to what is your fact pattern and doing it in proper proportion, because balance is always, no asset should be your only one unless you inherited it, and then you need to diversify it. But in the context of our conversation,
let's wrap up today, because I know that your practice, Jacobs Coolidge and Company, does do a lot of work with businesses, either entrepreneurs or larger existing businesses. Let's wrap up today with business uses of insurance. Okay.
So there's a number of things. We'll start with the owner and then talk about the employees. But business owners often work in the business, not on the business. And we encourage them to work on it strategically. What that would mean is having a business continuity plan where if something happens and they're the only key person, is there should be insurance on them, and perhaps something called a one-way buy-sell where the business can continue. But the purpose of business insurance in this context is to make sure that the business would have liquidity if something happens to the owner or the key person. With more than one owner, it's called a buy-sell agreement, and you have insurance on the owners so that if something happens to either owner or multiple owners, liquidity comes in and allows the surviving owners to buy out the family of the person, the owner who passed away. But you also would want additional capital because that owner very likely had a special skill set that you'll now have to replace. So there's the buy-sell agreement where you buy out the deceased partner or shareholder, and then there's key person coverage where if you have a great salesman or a great manufacturing director or whatever the key person is, your business is going to suffer if something happens to that person. And you can place a capital value, there's that word again, capital, a capital value on the loss of that individual. And as the owner of that business, you can insure against that loss by buying life insurance. And there's also a twist on that. If that person's a key person, you can also, using different mechanisms called deferred compensation, split dollar, supplemental executive retirement plan, you can actually use the insurance to retain these people. We talk about the 4 R's of recruit, retain, reward, retire, and you can use the insurance mechanism to build a pool of capital to then reward that person if they stay with you for an agreed period of time. And so that's called a deferred compensation plan. You know, we get so focused on earning money now, but we're not thinking about tomorrow. So if you as an owner use that tool to help assure that person's success in retirement, they'll very likely stay with you. So in summarizing, the business owner can use life insurance specifically and disability buyout insurance to protect in a buy-sell agreement. They can also use it to insure the business against loss of a key employee. They can also use it to ensure a future income stream that they've offered to pay to that key employee if they stay with them. And, often with buy-sell agreements, we see disability insurance left out. Again, we talked about that earlier, how it's kind of the stepchild of insurance for whatever reason. So, but a buy-sell agreement should actually address disability, death, divorce, and departure. And if you have a disability situation without a mechanism to fund that, then the business is going to have to do so. So again, it's about transferring that risk like we started the call. So I think, does that answer your question?
It does very, very well. This is a very deep subject, and working with somebody who not only has the certified financial planner designation, but also somebody who has the ability to make this analysis with lots of experience in lots of different arenas is very, very important. So, Russell, thank you very much for enlightening us today on the different aspects of risk management and insurance planning when it comes to the certified financial planner.
Well, you're welcome. I enjoy talking about it. I'm sure most people don't, but I really just encourage people to educate themselves and make a decision. So many people don't have any insurance, much less a proper amount of insurance. And it's like you said earlier, if you don't have to do it all, but do something, you and your family will still be better off. Yeah. I thank you for your time.
If your advisor has the CFP designation after their name and is not having this conversation with you, there is a reason, and ask. Just like Russell just said, there's a lot of people who don't like talking about this, but it's very, very important. And professionally, it is mandated to have these conversations. Working with somebody like Jacobs Coolidge and Company, who feels very comfortable having these conversations, can really, truly change your overall financial plan, because just one thing can interrupt everything that you've always worked very hard for. So for everybody at Jacobs Coolidge and Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs Coolidge and Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.